Good afternoon. I'm Chris Chelius, part of the Option Ranger Development Group. For anyone who missed previous webinars, give us a call at 800-519-9085 and we can send you the videos you missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you are a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. Now for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all-markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for the individual investor. And without further delay, welcome to Long Strangles and Short Strangles, When to Use and How to Calculate webinar. Mr. Mueller?
Thank you, Chris. Thank you all for attending. Today we're going to go ahead and do our next presentation, and we're going to go over some of the basics, and then we will proceed. As first of all, I'm sure everybody has read and approved the disclosure, which is an important portion of our program. And now let's go ahead. And today we are going to be using the Option Ranger. Our programming today will be on long and short strangles. The long strangles and the short strangles can be viewed in two calculators for learning purposes. They can be learned in the stock spread calculator and the future spread calculator, which are an intermediate step to modeling out spread trades in all markets. This is one step up from our basic stock and futures calculators, which are one-leg transactions. Finally, the long and short strangles can also be found and used on the master combinations calculator, which is the objective for all users to be able to use a single all markets calculator for their projections. When we view the strategy gallery, as you see, we are going to be looking at long and short strangles. And first of all, let's look at the scenario. Both of these trades, similarly to long straddles and short straddles, fall within the general category of trading in which the trader or speculator does not have a specific outlook on direction. As you are aware, when selecting a decision, in order to make a nuanced and complete decision, our model contemplates two inputs, the first being direction, which most people think about, and the second being volatility. Today's trades, as were the ones earlier this week, are strictly based on a volatility outlook without any forecast or expectation as to direction. This is for people that have no idea or no strong opinion on whether markets are going up or down, but these are people that have an opinion about volatility. As you can see, in the event of rising volatility with undetermined direction, the transactions would be a long straddle, which we've reviewed earlier, or a long strangle. These transactions, as you can see, rely on rising volatility and significant price moves, which are a result or a symptom of rising volatility, if you will. So the person who is buying a strangle in our today's scenario is a person that is anticipating a large move in one direction or another without having a specific or defined opinion as to which direction. Likewise, When we look at the short strangle today, again, this is a trade that is predicated with no particular directional outlook. It's an undecided directional outlook. However, the short strangle is a trade that is put in for a volatility falling outlook, meaning that there is an expectation that the market is going to be less volatile. It's going to make smaller moves, so it's going to go from large choppy action, as is illustrated here, which is for high volatility, with an anticipation of smaller volatility and narrowing trading ranges. So today's trades, again, are complementary to our series on undecided direction and decided volatility trades, which we began with the long straddle, and the short straddle. And as you can see, those are opposites of each other and counter trades. And likewise, in the case of a long strangle and a short strangle, again, they are mirror opposite images of each other. One illustration being for rising volatility on the long strangle, and one illustration being for diminishing volatility on a short strangle. As you are well aware, whenever you click on a particular type of a transaction, so let's in this particular case begin with a long strangle, we will go to the particulars of that trade in our strategy gallery with a discussion of the details of the trade, as well as a link to a fatal errors message in our beta testing module. So let's go ahead and see if we can pull that up another way. And let me just go ahead and pull out the Option Ranger calculator. If you'll just give me a moment. Let's go ahead back into our strategy gallery. And we're going to go to another scenario. Let's see if we can go ahead and illustrate the short strangle strategy, which goes to the same principle. Again, as you will see in both of these cases, where this is going to take us, hopefully, is a page in which the particular expectations on this transaction are being forecast, and let's go ahead and do those now. A long strangle, as you can see here, and as I indicated previously, is a transaction which requires a large move in either direction in order to overcome the time erosion and the premium paid initially for the transaction. A long strangle is a non-margin transaction because whenever you're long premium, you have no naked options written. Your maximum loss, your maximum possible loss, is predetermined and limited to the cost of the options that you purchased, which is to include the premiums paid and the commission costs. In the case of a short strangle, which is betting on diminishing volatility, that particular transaction is the opposite transaction. The profitability for the trade is within the narrow range between the strike prices that are sold, so the profit is limited to the premium collected minus transaction costs, and the risk is an unlimited margin risk because a short strangle consists of the writing of two naked options, in this particular case writing of a naked call and a naked put. To see further examples of these types of transactions, you can go to our reference material section, you can go to our video section, and as you can see, all of the different strategies are broken down with demonstration videos on how to input trades, multiple examples of trades, and they're broken out into categories. In this particular scenario, we are looking at a variety of spread strategies where these markets would appear, and also advanced strategies under which, as you can see, long strangles, short strangles, long straddles, and short straddles are listed here. So in the particular case of looking at a long strangle strategy, you would go through our demo library directly, and you would see here a description. This is a previous program on when to use long strangles and long straddles, and there's going to be a further discussion of and links as we develop this section of our content library on an ongoing basis. Now, without further delay, having discussed the particulars of long and short strangles, let's go ahead and look at some examples. Parenthetically, for those of you that have set up tabs in the past, we do have multiple previous examples dating back in this particular scenario as back as February 13th, well over a month ago. Today is March 27th. So we are talking about 6 weeks ago, the last time we did the long and short strangle program. And you can see multiple trades here in the bond market, in the T-note market, in the S&P market, and so on, that you can monitor for results, both large and small S&P, and you can go up and down the list. And if you can save these types of trades on your own tab or visit our tabs, or we can set them up on your tabs, you will be able to see, for example, how these particular trades would be looking in this particular scenario 6 weeks later. And again, these trades were used for illustration purposes, so the object lesson is not to comment on whether or not the trades made money, but rather how have the market movements and time erosion affected these trades from the standpoint of profitability or loss and risk. So now let's, without further delay, let's go ahead and have a look at our examples for today. And the first example will be in the 30-year bond market, and the first example is going to be a strangle in the T-bond market, in which will be a purchase of 136 call and a purchase of a 132 put. This trade, as you can see right away, contemplates there will be a large, significant move in one direction or the other in this market. And let's have a look at the values and the way this trade is broken out. Again, we're looking at the T-bond market. It's a long strangle. If you want to get more information about T-bonds, you can go to the dialog box and also click on contract specs. The minute that long strangle is selected, the appropriate boxes open up so that the correct inputs are made, or if you will, almost forced, because a long strangle consists of buying a call and buying a put, or buying 2 calls or buying 2 puts, and so on. So as you can see here, we know that when we select the long strangle as a trade, the input is buying a call, buying a put, so we don't make the mistake of inputting the wrong instrument or the wrong transaction. In the strike example, when you click on strike, there's an indication of how to input the strike price again, and a discussion of strike prices, and likewise with premium. When a premium is selected, then we have a discussion of premium and how the premium is input. So now let's go straight to the trade and see how it looks. In this particular case, the buyer of an option has the right but not the obligation, in the case of a call, to buy the underlying instrument at that strike price. So the person who buys this call, which is one leg of the trade, has the right but not the obligation to buy bonds at 136. The buyer of a put, conversely, has the right but not the obligation to sell the market at 132. So this person is essentially making almost opposing bets that they want to buy the market above or below these 2 levels, because they think, although they don't know which way it's going to be, that the big move is going to happen in one direction or another. So this is strictly a volatility trade. And again, because the buyer of options pays a debit, as we see now, the premium points are translated into dollars and cents. So the net debit on this trade, including costs, which have been input above, would be $15.93.75, and then of course you factor in your transaction costs, which takes you to $17.03.75. As you can see here, that is also your maximum risk on the trade. When a person is net long premium with no futures and no naked written options, the risk is limited to the cost of the transaction, the total cost of the transaction, which would include the premium paid, which is indicated here, as well as the transaction costs being factored in. The person who bought this Strangle, betting on a big move in one direction or the other, will lose the maximum amount risk in the event that the market stays flat, doesn't move in either direction significantly, and the position is not offset prior to expiration. The maximum profit, however, is unlimited, because once those initial costs are overcome, and they are translated both into premium points, which is 1.7 points, and those are premiums that you monitor all the time, or intrinsically at expiration. The market has to be below 133.3 or above 137.7. Throughout the course of this trade, it is highly recommended that you monitor these premiums very closely, that 1.7 number. If you can sell this spread for more than 1.7, there is some sort of a gain. If it's worth less than 1.7, there's a loss according to the tick value listed. And again, it's 31.25 per tick. At expiration, it's very important to note at expiration that you want to be below this number or above this number in order for the move to be big enough or volatile enough to intrinsically be making money. And now let's have a look at the sweet spot of the trade. As you can see, if the market is in the middle and is essentially working between two numbers on the drop, it requires a significant drop in order to get into a sweet spot of making money. And likewise in the event of a rally, and let me go ahead and increase the number of columns that we see so that you can get an illustration on the upside as well. Let me go hit the calculate button. You yourself can change the output feature on the rows and get a very clear idea. And as you can see, we are exactly in that range and beyond that range where the trade becomes profitable. So a flat market in the middle, especially between the two strikes at expirations, would result, if holding the position to expiration, as you can see, in the potential of the maximum loss that is possible under the trade, in this case 1703.75. If the market breaks out enough to exceed either the call strike price or to go below the put strike price, as you can see, the losses become diminished, and if the move is large enough to overcome the premium and costs, the trade becomes profitable. Again, the buyer of a Strangle should be very mindful that they need a very large move to make money beyond the strike prices of the range in which they think the market is going to be stuck. Now let's go ahead and have a look at a short Strangle, which is this is a long Strangle, so this person is looking for rising volatility. And now we're going to take just a moment, we're going to have a look at the short Strangle in this kind of scenario, and as you can see, we're going to use the very same strike prices. So this is a counterparty. We are looking at this trade from the standpoint that makes the most sense to a lot of people psychologically when they consider a transaction. We're looking at the opinion of one person who has no idea about direction but thinks that volatility is going to go up a lot. The market's going to fly or tank, so they buy a call and a put looking for a big move one way or the other. And then we look at the mindset of somebody who has the opposite opinion. Somebody who thinks that the market will stay within this range, likewise having no specific opinion about direction, but believing contrary to the long premium player, this person believes that the market's going to be flat or quiet down and stay in this particular range. What you're going to notice there, which is what makes sense in an opposite view, is what is the loss area in the trade on a long Strangle is the sweet spot for making money on a short Strangle. And what is the profit area on a long Strangle on a big move is the loss and margin risk area on a short Strangle. So we are really looking at this as a difference of opinion between two people and how that difference of opinion can be measured at risk and reward. So now, as you can see, the numbers are similar but flipped. When you input the trade, when you select short strangle, in this particular scenario again, all the particulars of the market come up, but now it's selling call and selling a put, so these inputs are automatically developed so that you will not accidentally put in buy, and you know the particulars and the composition of a trade right up front. Now, let's look at the box, and again, the flip side, the person who sold this call is basically betting that the market is going to stay under 136, because if it goes above 136, they have the obligation to take an assignment on that position, and in this particular case, to short the contract or the underlying instrument at 136. So they want the markets to stay below there. That's why they're betting it's going to stay below. And by selling somebody the right to buy at 136, the seller of that right is compensated with $843.75 in premium. Likewise, at the same time, this person who's looking for smaller volatility is also betting that the market will stay above 132, because otherwise they are making the commitment and taking on the obligation to sell at 132 to the person who purchased this option. So they have that obligation and the margin risk, and in exchange for taking that on, again, the seller of the short strangle, the seller of the premium, is compensated with a $750 premium. So by collecting the call and the put premium, looking for a flat market, there's a credit at this point of $1593.75. From that, we subtracted a default transaction cost, which leaves a net credit of $1483.75. In a short strangle, or in any short premium trade, or strictly of collecting premium, the profit potential of that transaction is limited to the net collected. So in this particular case, it would be the total premium collected minus the transaction costs gives you the net credit, and the net credit, no matter what happens in the market, is the most that one can make in the short strangle. So it's a limited profit potential. On the other hand, as we indicated previously, when you write naked options, you are taking on the risk of margin in futures, and in this particular scenario, that risk would be at 31.25 per tick move above the intrinsic break-even of 137.48. So this person would need the market to stay below 137.48, or would have to stay above 130.52. Otherwise, the move of the market would become large enough to overtake the cushion of the initial premium collected, and then the obligation to be long or short would overtake the amount collected and turn this trade into a loss. Again, while you monitor the trade, in addition to looking at the break-even points intrinsically for expiration at the two levels listed, one has to be very mindful to look at the premium values. In this particular case, in premium, the seller of these options collected 1.48 points. Let's call it 1.5 to round up and make life easy. So this person would need to be able to buy back these options for less than 1.5 in order to make money, for less than 1.48 to be exact. And if this particular speculator has to pay more in order to buy back these options, then losses would begin, because they will have collected 1.48. If they want to have to buy back for 2.48, that means that they're spending more than they collected, so they lost a basis point. if they can collect less. Let's say somebody comes in and says, and this option erodes as to time, their options at 0.48 or thereabouts, and they'll say, well, I made 1 basis point, that's $1,000, and they can decide to offset position or hold it to expiration. So it's very important to monitor the premium throughout the trade. Be sure that you're set up with your tracking platform so that you can monitor that premium and, in part, inform your decision about what to do at expiration by looking at where is this low break-even point? Where is this high break-even point? Is your volatility outlook still unaffected? And now when we're going to look at this trade, you're going to notice that it's totally different. Unlike in the previous scenario, and let me go ahead and increase the number of rows so we get a bigger picture, especially because we are measuring risk on one side, so we want to make sure we look at more rows so we get a more complete picture of the potential risk in the event of a large move. And as you can see here, as opposed to the long strangle, the short strangle sweet spot is between the 2 strike prices, whereas the long strangle sweet spot is outside of the 2 strike prices. So you can see very clearly how in this particular scenario, the flatter the market, the better, and should the market expire, if one holds to expiration, between the 2 strike prices, the maximum gain of 1483.75 would be reached. Because there was a credit to begin with, even if the market does exceed those levels, so let's say if it drops somewhat below 132, let's say it ends up at 131, as you can see, because enough money was collected at expiration, although that 132 was exceeded, a pretty decent sized move according to these volatility expectations at least may have occurred, and yet because of the premium collected not just on the put but also on the call, this position can go in the money at expiration and still have some gains. That's all we want to make sure that when we list the break even on futures and on premium, we factor in all those things. So let's say, for instance, if the market's headed towards 132, person pretty good about their support, it's 1 or 2 days to expiration, they can still quickly have a look at the intrinsic value where the position would have to be at expiration, along with looking at the ongoing premium. Now, as you can see, this position also on a rally, if the market does run up beyond that sweet spot between 132 and 136, there's a margin of error because of the premium collected. In both the case of a long strangle and in the case of a short strangle, in this case here, as you can see now, if the market runs up in a very big way, this is a margin position, and on a significant upside move in this particular case, let's say interest rates really drop and bonds are going up very strong. As you can see, past a certain level, the increase goes tick for tick, just like the futures, because it's a naked call. And likewise on the short side, where the put was sold, once those costs are overcome, the premium collected is overcome, the bigger the drop, the bigger the risk, and the bigger the potential losses. And as I indicated before, these are margin trades. They can go tick for tick against the position on the futures. So somebody is looking for the sweet spot in the middle and thinks this is a good margin of error and is anticipating low volatility should nonetheless be mindful and look very closely at these numbers and see if their risk tolerance is such that they can endure an unanticipated event and a larger move against the position in either direction. And so again, now we've seen the 2 counterparties in this particular trade, both on the bond, on the call, and on the put side. Let's go ahead and take a minute also to look at a market we've looked at previously. Let's look at, we had a look at Amazon on a straddle. So let's go ahead now and let's go ahead and have a look at an Amazon long strangle. And then we're going to have a look at an Amazon short strangle. Okay, and again, the scenario and outlook is the same. A person who is along this strangle is looking for a very big move. They're looking for the market to break out above a certain number. Excuse me. They're looking for a number to break out above 400 with enough volatility to overcome the premium paid, or collapse under 270 with enough volatility to overcome the premium paid. And let's have a look at the particulars of the trade. Again, this is an illustration. It's not a recommendation. It's just a way of looking at volatility and ranges. As we remember, the buyer, in this particular case, the buyer of the option is looking for the market, is in this particular case is looking to have the right but not the obligation to buy the stock at 400, and in exchange for that right they're going to pay $500. Gives them the right but not the obligation to buy the stock at 400, so obviously it would have to be well above 400 for that to be profitable, or there would have to be a big change in volatility. By the same token, again, the same person is thinking that, on the other hand, they want the right but not the obligation to sell the stock at 270. And in order to purchase that right, they pay $4 in premium, and on 100 shares, that's $400. So between the call that was bought and the put that was bought, there's a total outlay in premium of $900. Then we factor in a transaction cost of $20 for, and we see that the total outlay for this long strangle is $920. As we indicated before, when a person is a buyer of premium and is long premium without any margin instrument or naked option sold, as you can see, the net debit, the net amount paid for the trade, is also the maximum possible risk on the trade. So in this case, the maximum debit and the maximum risk are the same at $920. And this is already factored in costs. The maximum profit, on the other hand, because the person is long premium, is unlimited. So if the market takes off and overcomes all costs and breaks out to the upside intrinsically above 409.20, or breaks down intrinsically below 260.80, then whatever the size of the move intrinsically tick for tick would be the gain on the position beyond those levels. This gives one a sense on a chart where they think the market may break out to one way or the other. To monitor the trade on a day-to-day basis, we have to look at the actual premiums, and in this case, the premium that is collected would have to be more than 9.2 or $9.20. So whether one waits till expiration for a breakout above this above the call number or below the put number, or monitors the premium throughout the trade, both factors are important in making your decision and developing your outlook on how, if, and when to offset. Now, as you will know, again, the feature of a long premium trade, a long volatility trade, and again, let me just make sure that we increase the number of rows to provide a fuller picture. In some cases, fewer rows will work if you're looking at a narrow range, but in this case, we're looking at a volatility expectation. So let's have a look. As you can see here, on this particular transaction, the sweet spot for the trade, is between these two strike prices, and between those two strike prices, the strike prices of 400 and 270, their maximum loss is incurred because the market did not break out, the rising volatility expectation was not fulfilled, so that the maximum risk can be would be incurred in this particular scenario. And the way for the trade to become profitable is either on a significant rally or on a significant drop. On the counterpart of the trade, now this is again a person who's long premium and thinks the market's going to break out one way or the other. So they're looking for a large move either way. If the market stays flat, then they're at risk of losing the 920. The opposing view on this particular position, let's have a look at that now. And again, as you recall, once we input the transaction, we input short strangle, the rows are set up. So we know that we're just selling calls and puts. So this box opens up. All we have to do is input the number of positions. We already know that they have to be calls and puts. Then all we need to do is find the strike prices and the premium, and we do the calculation. And now, again, this particular person is selling a call on this particular stock. In this particular case, the example is on Amazon. And it's the opposite trade. Now, instead of spending $5 to bet that the market's going to break out strong above 400, this person is collecting $5, betting that it's not going to break out above 400. By the same token, as you can see here, the seller on the other side of this transaction, again, is not betting that the market's going to break down hard below 270. Rather, he's betting that the market will stay above 270. So this seller is taking on the responsibility of buying the stock at of having to put the stock at 270 or at 400, being assigned at 400, and in exchange for taking on that obligation and risk, they are collecting $500 and $400, which, as you will recall, is the exact opposite for the person who is long these positions and is spending. So in this particular scenario, instead of a debit, this person who is betting on diminishing volatility is collecting a credit of $900. Try to make it convenient with red and green. And of course, we always factor out transaction costs. And again, in this scenario, because it's a short trade, it's a debit trade on premium, and it's a margin trade, the maximum that can be made in this particular transaction is the net premium collected. The most person can make when they sell an option, they write a combination of options, is limited to the net amount collected, which is the premium, and of course then you have to deduct whatever it costs to collect that premium, the transaction costs. In this case, as you can see, the maximum that can be made is the maximum which is equal to the net collected. On the other hand, the risk, and obviously it's put in red because we want to always emphasize risk. There's no point looking at the profits if the risks are intolerable. So in this particular scenario, the risk is $1 per tick move, either above the break-even intrinsically of 408.80 or below 261.20. And as you can see here, that has also been translated into premium points, so the trade can be monitored throughout the time prior to expiration. So if a person is looking at, has this much tied up in the trade, if they can get out of it for $5 less, then they made $500 based on the tick value that we have at $100. So 5 times 100 is 500. And if they have to pay, and of course if they have to pay $5 more to get out than they collected, then they would be losing 5 times 100 is 500. So you monitor the premium at all times to see how the position is being impacted by intermediate moves, by current market moves, as well as by volatility outlook, and always determine whether or not you want to set up an exit based on premium or whether you want to set up an exit by monitoring the intrinsic value and come up with an informed decision using both factors, both where the market has to go intrinsically as well as current premium values. And then, of course, in this particular scenario, as you can see as well, and we can go to the spreadsheet, the sweet spot, as long as the market holds between these two levels, the trade will break even, the trade will make the most money, as long as it stays below 400 and above 270. And obviously, the more in the middle it is between those two numbers, the better time erosion and the better the opportunity for an early offset. On this particular market, again, as you can see, we have a sweet spot down to 290 here. We still have to go down to 270 to get into the negative numbers. And as you can see, this is where we start hitting the negative numbers. When we break under 270, we overcome the premium that was collected, and that's when the trade gets into negative numbers on a drop. And likewise on the opposite side of the trade on a rally, because we need a move beyond 408.80, we will have to add some additional rows in order to see this transaction. Let's see if we can go ahead and take this to 100 rows and see if we can have a look here at the risk on the upside move. We're going to need to add more rows and change the spacing. That's why we're in a beta group. But again, as you can see here, on a drop, you can see the risk tick for tick, and likewise on a rally. If there's a breakout beyond this point tick for tick, for every dollar move, there's a loss of $100 because it's 100 shares per option contract. So those would be two examples of comparing a long and a short strangle. We are going to be doing further examples of this using the strategy gallery in the future, and be sure to check out our reference section where we already have some of these examples listed with videos from former sessions and demos on how to input. Do we have any questions?
Yeah, Mr. Mueller, we have a question actually. Could you talk about a scenario that each particular trade or type of strategy is useful? For example, maybe prior to a news event or an expiration. Could you talk about a potential scenario where each trading strategy would be most valuable?
Okay, that's actually a very good question. It's an important question. So let's go ahead and think of a couple of scenarios, and I think that let's put these in the context of an expiration or a major event. It is generally volatility outlook, and this is more discussion about volatility, changes depending on the fear factor in a given market or on the level of excitement or anticipation of large moves. So for argument's sake, let's say that there is a given market is very quiet. So let's have a look here at the example of using a long strangle. So the person doesn't know what's going to happen, but they think something big is going to happen. Let's say there's a report from the United States Department of Agriculture, and a person feels that the market is extraordinarily complacent ahead of this report, but that something shocking may come out in this report that is going to make this market fly one way or the other. And the person doesn't know which way it's going to be, but they have reason to believe that it's going to be a shocker and the market's going to move. That means that this person has an expectation of rising volatility, and that their rising volatility is based on the belief that the market is too tame and too relaxed, that this report is being taken for granted, but that after this report comes out, there's going to be a large move one way or the other. That person would be a person who would look for a long strangle or a long straddle, because they are anticipating a large move that is going to be sufficient to overcome the cost of being both long and short directionally in this market, which is neutral, but looking for a big move. By the same token, and this is sometimes the case, take a counterparty that is looking at the same report coming out, and let's say there's a lot of excitement. The market is extraordinarily volatile. All prices are jumping up and down. Nobody knows what's going on. There's a huge range of forecasts and expectations in the market, and somebody says, well, people are overly excited about this market. they're paying a lot of money for calls and for puts because they're looking for all kinds of outsized crazy moves, and this person says they're overreacting, they're paying too much premium, the report's going to come out, nothing major is going to happen, and the volatility is going to drop and the premiums are going to diminish, that person might turn around and do a short straddle or a short strangle. Again, not knowing which way the market is going to go, but thinking that it is way overheated and overactive, and that once the news comes out, it's going to quiet down within the range and the premiums are going to drop. The person who does this type of trade, a short strangle or a short straddle, often would be the type of person who would say something like, buy the rumor, sell the news. So there are people who are going to make the market run ahead of a report, and then after the report, things quiet down. So you are looking at totally different expectations on volatility. Likewise as to expiration. If an expiration is coming up, there is generally an anticipation that the closer options get to an expiration, the greater the time erosion. And that may not always be the case, but it's generally the case, except under unusual volatility scenarios. So let's take the rule more than the exception, and let's say that a market is really eroding going into expiration. Let's say, for instance, it's the crude oil market, and somebody in the middle of the night has a dream that something crazy is going to happen in the Middle East, and resulting in huge volatility, and there are options that are very close to expiration, but they have the strong sense, whether it's an opinion, a premonition, whatever makes people decide on an outlook, and that person will say ahead of expiration, I'm looking for rising volatility. These options are really eroded, but if there's a big, big breakout move quickly, they could benefit from such a move. So they could use an option going into expiration if they think that they are too cheap or overly eroded and they are looking for rising volatility. By the same token, and there's a whole class of speculators and traders and CTAs who do this, somebody nearing volatility who thinks that time erosion is really going to begin to do a job now. They anticipate no major moves afoot in the market and are in a position to handle the risk of margin, which is required both for short straddles and for short strangles. Then that person can say, I'm going to go for some quick premium income close to expiration and look for the time erosion that's going to occur in this area to make the trade profitable. So both expirations and reports can be used with a volatility outlook to determine which way one is going to go. Again, bear in mind that in this case we're looking for an entirely undecided directional outlook and strictly a volatility forecast. Somebody ahead of a report or ahead of an expiration might come up with the same opinion, and let's say they think, well, I think the volatility is going to go up, but I think the market's going to go down or up. Again, for somebody looking for an increase in volatility, they can fine-tune that if they also have a directional outlook and combine for a position that is more directional along with rising volatility. And if they have a bias that volatility is too high, they can also add in a directional outlook to do some kind of a short premium strategy. Again, everything is a function of determining, in these cases, especially in the non-directional trades, having a nuanced volatility opinion against the expiration date of the option. Is there another question? Or is that a follow-up?
No, that's the only question.
By the way, trading into reports and trading ahead of reports and anticipating reports and working with expiration, these are some of the most important ingredients in making volatility decisions. And as you are well aware, if you go to our market section, when you go into our market section before you trade a particular market, in order to find out when those report dates are, and to find the expirations for different contract months, you go to our market section. You can go by sector, select a particular contract, and then you will get all of the particulars on that contract, including what to monitor, what factors might influence volatility up or down, a listing of key reports as well, so that people can make informed decisions as to their volatility outlooks, as well as directional outlooks based on the particulars of a given market. Okay, so again, I want to, if there are no further questions, I want to thank everybody for attending today. I think clearly there's some work proceeding on the site. We're very excited. We hope you learn more about volatility and the non-directional volatility only breakout trades that we've examined this week. And if you have any questions, please be sure to post them to the forum or contact our customer service directly. Thanks again. We'll be following you up tomorrow on some of the big markets. Today's the 27th, so Friday the 28th. We'll be following up on some of the trades that we've been modeling to see the impact of volatility and direction on the trades as input. Have a great, great afternoon, and remember, be very cautious and fact-based and number-based in your trading.
Thank you, Mr. Mueller.